Welcome to today's Explainer. We've got a wild, highly volatile 24 hours of global geopolitics to unpack today, and we're going to run through all the actionable, tactical levels you need for major currencies and Indian markets right before the opening bell. There is a lot of ground to cover, so let's jump right in.
All right, let's kick things off with the number that is literally dictating the entire global risk-off mood right now, $89. That's $89 a barrel for Brent crude. With geopolitical tensions keeping everyone on edge, this price is finding a ton of support from severe supply risks, intensifying tensions in the Middle East, and all those ongoing shipping disruptions we've been seeing.
Because overnight was intense, to say the least. The US launched its 10th straight night of strikes on Iran. Pair that with a tanker incident in the Strait of Hormuz and some fresh Houthi threats, and, well, the market reaction was incredibly swift. Wall Street totally surrendered its early gains. The Dow erased nearly 600 intraday points before closing sharply lower. Meanwhile, all that geopolitical fear, plus the rising oil price, pushed the U.S. 10-year Treasury yield up to 4.57%. So much for last week's optimism about softer inflation, right?
And adding some serious fuel to this rate pressure fire, we heard from the newly appointed Fed Chair, Kevin Warsh. Testifying before the Senate Banking Committee, he offered this surprisingly candid take on how the central bank is going to approach monetary policy from here on out. It's a very clear signal. The Fed is intensely focused on the choices they have to make right now, which is absolutely keeping rate cut optimists on the defensive.
So what's on deck for today? Well, looking at the hours ahead, we have plenty of macro ammunition coming out to keep you fully caffeinated. Our focus shifts squarely to incoming data. Specifically, we're watching the UK employment figures, Germany's ZEW economic sentiment surveys, and of course, those highly anticipated US weekly ADP employment numbers.
Let's head over to Section 1, the Tactical Chart Room, starting with major currencies.
Starting with the greenback. The US dollar index caught a massive bid on those geopolitical fears, climbing right past 100.9. In uncertain times like these, the dollar is basically the market's favorite comfort blanket. Plus, that 10-year yield we just talked about is acting as a major fundamental floor for the dollar as we head into today's US ADP print.
So how do we play this? For the DXY, the crucial strategy here is maintaining a buy-on-dips approach. We've got solid support sitting at 100.89 and 100.57. But you're going to want to keep a very, very close eye on that 101.41 resistance level on the upside.
Jumping over to the Eurozone, we are seeing a really fascinating dynamic. While broader inflation has actually eased off across the zone, the German 10-year bund yield is creeping back up to recent highs. Everybody is closely watching to see exactly how the market digests this current spike in energy prices alongside today's ZEW economic sentiment data.
Tactically speaking, resistance at 1.1447 is holding its ground against a recovering dollar, with your next support down at 1.1388. But definitely watch that resistance block, especially the 50-week moving average at 1.1464, just in case the index manages to find some fresh upward momentum today.
Now, over in the UK, bond markets got thoroughly spooked. The UK 10-year government bond yield actually blew right past 5%. This happened as the new Prime Minister, Andy Burnham, along with his surprise Chancellor pick, John Healey, recommitted to fiscal rules, but simultaneously signaled a desire for fiscal flexibility. And let me tell you, flexibility is a word bond markets treat with intense caution. Which beautifully sets up the GBP/USD ahead of today's crucial UK labor data. The pair remains a buy on dips. You've got support sitting at 1.3393 with some really strong immediate resistance right at 1.3450 and a secondary resistance ceiling up at 1.3558.
Turning to the yen, USD/PGY had yet another range-bound day, and man, this squeeze just continues. With Japanese cash markets closed for the Marine Day public holiday and Ministry of Finance intervention chatter totally quiet for the moment, the yen is getting perilously close to a point where a breakout or a breakdown is absolutely imminent.
Because markets are going to keep testing the Ministry of Finance's resolve, you have to be incredibly disciplined today. Tactical trades only here, folks. The play is either buying on a firm break of 16,271 or selling at that exact level. But make sure you are keeping a super tight stop at 16,300, no exceptions.
All right, moving right along to Section 2, India markets, let's break down USD INR and Nifty equities.
Looking at the currency, Those higher oil prices we discussed earlier brought out heavy importer demand for dollars, which weakened the rupee to a close of 96.445. It's basically back within striking distance of its May record lows. Now, the fall was cushioned by what looks like RBI intervention on both onshore and offshore markets. Meanwhile, one-year forward implied yields inched up by about 6 basis points to 2.95%.
For USD/INR, the tactical play here remains buy on dips. Assuming the RBI continues its buffering strategy, you're looking at supports at 96.18 and 95.82, with the next upside target looking toward 96.90.
Over on the equity side, markets closed lower after some pretty heavy selling. Indian banking stocks took an absolute beating post-earnings mid-week global cues, and the Nifty Private Bank Index was actually the worst performer, dropping 2.2%. But here is the crucial divergence you absolutely cannot ignore today. The broader market refused to join the pity party. Midcaps completely outperformed the benchmarks and actually gained 0.6%.
And looking at the Nifty chart, that early gap-down dip was actually bought into really nicely. We are keeping our buy-on-dip stance right here. You've got immediate resistance at 24,344, and a break there opens the door to 24,561. On the downside, crucial support sits at the 21-week moving average of 25,140, followed by the congestion zone down at 23,900.
So let's wrap this up with a thought. As tactical trading increasingly outweighs long-term investing, a totally new market reality has emerged, where short-term sentiment is just the loudest voice in the room. It really begs the question, are headlines actually driving the prices we just looked at, or do prices just conveniently rewrite the headlines after the fact? Keep that dynamic in the back of your mind as you navigate today's open. Trade carefully out there, and thanks so much for joining this explainer.